Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. In Part 2, we'll cover practical tips on investing in platinum and palladium, including where to buy, risks to consider, and how to balance your portfolio. Let's jump right in. Mining stocks and futures. Want bigger potential gains and risks? Mining stocks and futures offer leveraged exposure to platinum and palladium prices. Mining stocks let you bet on companies extracting these metals, like Impala Platinum and Sibanye-Stillwater. Stocks can soar when metal prices rise, but they also carry operational risks. Labor strikes, political instability, or cost overruns can hurt shares even if prices stay high. Futures contracts are even more advanced. You agree to buy or sell metal at a set price later, speculating on short-term moves. The COMEX and NYMEX offer platinum and palladium futures. Why try futures? Because they can multiply gains with less upfront capital. Why avoid them? Because losses multiply too, and contracts expire, making them better suited for traders than long-term investors. Each approach has its place. Physical metal suits purists. ETFs balance simplicity and exposure, while stocks and futures are for those comfortable with higher stakes. Your choice depends on how hands-on you want to be and how much risk you can handle. Risks and challenges. Investing in platinum and palladium isn't without its hurdles. While the potential rewards are compelling, understanding the risks helps you make smarter decisions. From price swings to geopolitical drama, these metals come with challenges you won't face with traditional assets. Market volatility. Prices of platinum and palladium don't move in slow motion. Industrial demand shifts quickly, and economic cycles can send values soaring or plummeting within months. For example, palladium prices tripled between 2016 and 2020 due to auto industry shortages, then dropped nearly 40% in 2022 as supply stabilized. Platinum swung by over 20% in 2023 alone, reacting to fluctuations in car production and hydrogen energy projects. Unlike gold, which leans on safe haven demand, these metals are at the mercy of factory activity. A slowdown in electric vehicle adoption? A drop in jewelry sales? Each ripple hits prices hard. If you're uncomfortable with roller coaster moves, this might not be your market. Liquidity concerns. Selling platinum or palladium isn't as easy as clicking sell on a stock. Physical metals take time to offload, especially in larger quantities. Dealers often charge fees, and finding buyers at peak prices isn't guaranteed. Here's what slows things down. Premiums and spreads. Buying coins or bars costs more than the spot price, and selling often means taking a discount. Verification delays. Authenticating heavy bars or rare coins eats up time, unlike instantly tradable ETFs. Local demand. In some regions, finding a buyer for palladium coins can take weeks. ETFs solve some liquidity issues, but even then, trading volumes for platinum and palladium funds are lower than for gold or silver. You'll need patience and a plan to exit smoothly. Geopolitical risks. Most platinum comes from South Africa. Most palladium comes from Russia. If that sounds like a recipe for supply shocks, you're right. Past disruptions include South African mine strikes, Russian export restrictions during Ukraine sanctions, which squeezed palladium supplies globally. Even smaller producing nations, like Zimbabwe, can roil markets with policy changes. Mining taxes, environmental regulations, or labor disputes can yank supply chains overnight. Diversifying across mining stocks or ETFs can soften these blows, but you're still exposed. Geopolitics is the wild card here. One you can't predict, only prepare for. Future outlook for platinum and palladium. The long-term potential of platinum and palladium hinges on two key factors: advancing technology and shifting investment trends. These metals aren't just shiny hedges. They're integral to industries driving the next wave of innovation. Let's dig into what could push demand and prices higher in the years ahead. Emerging technologies. Platinum and palladium are quietly powering tech breakthroughs. Their unique properties make them hard to replace in critical applications. Platinum's hydrogen revolution. Fuel cells for hydrogen-powered vehicles rely on platinum as a catalyst. With governments pushing green energy, countries like Japan and Germany are betting big on hydrogen infrastructure. The EU aims to install 40 gigawatts of electrolyzers by 2030, which could double platinum demand from this sector alone. Palladium's EV dilemma. While electric cars don't need catalytic converters, palladium still plays a role in hybrid vehicles and legacy fleets. Until EVs dominate globally, palladium stays relevant. Battery researchers are also testing palladium alloys to improve energy density, creating a potential new demand stream. The catch? Technology moves fast. If cheaper alternatives emerge, like fuel cells needing less platinum, prices could stagnate. But right now, these metals are writing the playbook for cleaner energy. Investment trends. Market watchers see platinum and palladium as high-reward bets, but with clear risks. Here's what analysts are tracking. Price catalysts for platinum. South Africa's power crisis limits mining output, tightening supply. Auto manufacturers may switch from palladium back to platinum if the price gap widens. Palladium's wildcard factors. Russia's export policies remain unpredictable, affecting 40% of global supply. Substitution threats loom. Automakers might use more platinum or even tweak engine designs to reduce palladium use. Most forecasts suggest platinum has more upside, trading below its historical average relative to gold. Palladium faces headwinds, but any supply shock could send prices soaring again. Investors are also eyeing ETFs differently. Physical palladium funds saw record inflows during last year's price slump, signaling long-term confidence. Platinum mining stocks, meanwhile, are rebounding after a decade of underperformance. The bottom line? These metals won't move in lockstep with traditional assets. Their futures depend on how quickly technology adopts them, and how smoothly miners can keep up. Platinum and palladium offer more than just portfolio glitter. Their rarity and industrial demand create a unique investment case, balancing growth potential with tangible value. Unlike gold, these metals thrive when industries expand, making them dynamic hedges against inflation and market volatility. Diversification is their strongest perk. Adding even a small allocation can smooth out risk while capitalizing on global trends like green energy and tighter emissions standards. But remember, their prices swing sharply, and geopolitical or supply shocks can impact returns overnight. If you're ready to explore, start small. Research ETFs for easy exposure or consider physical coins for long-term holdings. Consulting a financial advisor can help tailor these metals to your goals. Want to dig deeper? Check out trusted refinery reports or follow market updates from sources like Kitco or the World Platinum Investment Council. Smart investments start with good information. This video was made to help you make informed choices. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.